Hello, hello, hello. Hello, good morning. All right. So, first of all, if you're watching this on the replay, make sure you hashtag replay so that I know that you were here because my replay squad is everything. Thank you very much for watching. If you're watching this on YouTube, thank you very much. And let me know who you are and where you're coming in from. Also, yeah, you can skip ahead about a minute and a half to get to the content. So while you're jumping on, I am going to be sharing this out to a few of my favorite spots, making sure my technology is working. And then we're going to get down with the get down. All right. I need my phone to wake up. It's going to be awesome. So just to let you know what's in the works, I'm going to be turning this into a podcast, guys. So I'm actually jumping on into the podcast arena. I have been kicking this around for many, many moons. And so now I am finally here. So, okay, let me share this out. And then I'm going to, then we'll get going. Hit the wrong button. All right. Okay. Okie dokie schmoky. All right. So let me officially welcome you to the show. Welcome to Tax Talk with LaSundra Everett. I am the Home Biz Tax Lady, where I help home business owners win the tax game. Tax Talk airs Monday through Friday, 9 o'clock-ish. And when you tune into my show, you're going to hear about topics that are important to home business owners. So when you tune in, it's going to be a variety of topics because taxes are not just one thing. Taxes affect your entire life. Okay, but I focus mainly on my home business owners, and so today I am answering the question about inherited land. I have one person in my audience who inherited some land from her mother. And she wants to know now, how will she be taxed on it? So there are a few things that you need to know. First thing you need to know is your basis. Now, usually when you hear the word basis is what you paid for it. So if you buy a car, for instance, if you buy a car for your business and you pay $12,000 for it, that's your basis. But since you inherited the land, you really didn't pay anything for it. So what you get is is a stepped up basis, right? So that means that your basis is the fair market value of the land at the time of your mother's death. And so let's say that she paid $20,000 for it when she bought it. And then she's, at the time she passed, it's worth $70,000. So then your basis would be $70,000. All right. Now, with that in mind, if at the time that she passed, the land is worth $70,000 and then you sell it for $90,000. Well, then you have a gain of $20,000. That gain will be taxed at the applicable capital gains tax rate. And that varies. So there are a lot of things that go into your capital gains tax rate. So I can't tell you exactly what that percentage would be, but it's going to be at the capital gains rate. And so if you are, let's say you're splitting that with a sibling, then you would be taxed on your portion. They'll be taxed on their portion of the gain. So, in that example, if you have a $20,000 if you have a $20,000 gain and it's split between two siblings, then you're going to pay capital gains on the $10,000, and then your sibling is going to pay capital gains on their $10,000. Okay, so and this is the same with property as well. For instance, if you have a home or home on some land, the inheriting the property. One of the things that we have to think about really is that succession plan, like where things are going to go and how you're actually going to pass these things along. And you do have to think about the tax implications. I'll give you an example. I had a young man that was a client of mine, and his parents hooked him up completely. Okay. So what happened is, before his parents died, they actually deeded their home to their children. Okay. So there was always a child that was living in the house, and this young man happened to be the youngest and was the last in the home. And so he lived in the home the required amount of time. So therefore, he could, when he sold the house, he could exclude, $250,000 of the gain because he actually lived in the house. So when you inherit property, it's like an investment property. Okay. So when you think about your home, if you're going to be passing your home on to your kids, then, you need to think about that. Is a way for a kid to come live in this house, have them, their name on the house, and they live in this house for the required amount of time, so they can exclude some of the gain when they sell the home. Okay, instead of paying taxes on the entire gain, there is $250,000 exclusion for single people. So this young man was able to sell a home and get $250,000 tax free. Yay, mom and dad, because mom and dad did some thinking. So again, this is why you need tax people in your life. All right. So, so with inheriting the land, the main things that you need to know is you need to know what your basis is, what is the fair market value of the land at the time of your mother's passing. All right. And then what you sell it for, whatever that difference is going to be taxed at the capital gains rate. And if you're splitting it with the sibling, then, or siblings, right, then you pay capital gains on your specific portion. So, that's really it. That's the short, cut and dry answer to inheriting property. But, on a planning aspect, though, and that's what, I really want to get to, when we're talking about, being parents and passing things on to our kids, we really need to be planning for the most tax beneficial way to our kids to reduce that tax liability and reduce your tax footprint when it comes down to, to disposing of property after you pass on. I mean, you might have, some huge house that the kids don't want. You might have a whole bunch of stuff that your kids don't want. So, we being responsible adults need to do what's best for our children so they don't have to worry about it after we're gone. Okay. So, and tax planning as far as inheritance goes is definitely one of those things that we need to plan on so that we don't leave our, we have the best intentions with leaving things to our kids, leaving a legacy to our kids, but we also need to look at the tax implications of, of leaving, that legacy behind. How can, you definitely reduce the tax liability for our kids when they inherit our property. Okay. And get some property for them to inherit too, right? Let's do that. Listen, real estate is one way to build wealth. Okay. If, get some dirt. God is not making any more, right? Get some, real estate is, one way to create wealth, and even life insurance. Okay. If you don't have some land, some property to pass on to your kids, get a life insurance policy so that when you pass on, you're leaving, some money to your kids and, and their kids' kids, and their job at that point is to grow it and start leaving a legacy of wealth for our families and not a legacy of debt. That was totally an aside, had nothing to do with this inherited land, but hey, had to throw that in there anyway. All right. So that's it for Tax Talk for today, you guys. Thank you so much for tuning in. Like I said, we air Monday through Friday, 9 o'clock-ish, and we talk about topics that are important to home business owners. All right. Have a fantastic day, and I will see y'all next time. Bye.